One of the important statement in financial accounting is balance sheet. Balance sheet provides information which is required to understand the health of the business. So if the balance sheet is healthy, the business is considered as doing well. And if balance sheet is weak balance sheet, then it shows the performance of the business. So balance sheet plays a vital role in understanding how the business is doing in the market. Balance sheet is also a statement which is provided to our stakeholders. They will assess before giving loans to the company, or if government wants to renew the license, if auditor wants to understand the consistency or continuity of the business. Balance sheet is a very important tool to understand the position of the business. All right. So let us look into how a sample balance sheet looks like. A sample balance sheet will have two elements, one on the left side and one on the right side. The left side is called assets and debit in the technical language, and the right side is called liabilities or the credit in technical language. So in accounting, typically, if we record something on the left side of the statement, then we consider that as a debit. And if we record something on the right side of the statement, we consider that as a credit. Okay. There is no rocket science here. Left side is debit, right side is credit. So when we record something in the left side of the balance sheet, we record all the assets. So there are different types of assets. There are current assets, there are non-current assets. So folks, if you see what are the current assets, why do we call it as current asset? It is because it is usually for short-term period and it can be easily converted into cash and cash equivalents. For example, let's take an example of accounts receivable. What happens in accounts receivable? You give customer some of your goods or services on credit, right? And the credit will prolong for a period of, let's say, 30 days, 45 days, 60 days, 90 days, or maybe sometimes in exceptional cases, 180 days. You will not give a credit beyond that maximum threshold, right? So this receivable has to come into business before a short-term period, which could be 90 days, 30 days, or 45 days. That is why it is called as current asset. All right. Similarly, cash. Cash is your current asset. It can be, it is it is very handy to utilize that cash. Similarly, bank balance is a current asset. It can be converted into cash and cash equivalents easily. Now let's understand what are non-current assets. Non-current assets are assets which cannot be easily converted into cash and its equivalent, and it requires huge investment. And the investment is done citing the usage for a longer period. For example, maybe 5 years, 10 years. Let's take an example. If you are giving a laptop to an employee in the business, we assume that the laptop will at least help an employee to deliver his tasks for 3 to 5 years, maybe normally. Similarly, if we provide a vehicle to your staff, we assume that the vehicle will be available for your staff for a period of at least 10 years or maybe sometimes 20 years. So any asset which has got huge investment, if you're buying a car, it requires a lot of money to be spent, but equally it is giving economical benefit over a period of long run, which we have discussed earlier. Those assets are considered as non-current assets. Remember one thing, these assets cannot be converted into cash and its equivalent quickly. It takes a relatively a longer period for assets to convert into cash. For example, if you go and sell your vehicle, it cannot be sold instantly. You need some time to, assess the market value, see how much someone is ready to offer to you. It requires efforts and time. That is why it is also called as non-current assets. So let's see what are current assets. Current assets are typically cash, accounts receivable, prepaid building rent. Accounts receivable are receivable from customers. Cash, you guys know what cash could be. Anything which is in hand, which is in liquid cash. Prepaid building rent means if you have given any advances towards your expenses. For example, here in this case, building rent, you have taken an office premises. The landlord asks you to give 3 months rent in advance, right? Normally this is the normal norm, depending upon the geographical region you are. Sometimes they ask for 6 months, sometimes for 1 year. If you're getting a good contract of rent, you might as well contract for 1 year. So you pay upfront post-dated checks for a year or 6 months. But that is not an expense for current month, right? It is an expense for future months. So anything which you have paid in advance is considered as asset, because if you wanted to vacate your building, the advance which you have paid to the landlord has to be returned to you. So it comes back to you. That is why it is an asset. Okay. Similarly, unexpired insurance or prepaid insurance. So you have subscribed for insurance of all of your employees for 12 months period, and you cannot take the 12 months full cost in 1 month, which will give a bad profits into your P&L. So you need to bifurcate or divide that expense monthly. Until then, that will be parked as an advance in the balance sheet. So if you cancel an insurance in between, the proportionate available period will be returned to you as a credit note or as a refund from the insurance company. So again, it comes back to you if you're canceling or abandoning the contract. Similarly, if you have any small supplies or small items like tools, equipment, or things like that, which is considered as short-term assets, are considered as current assets. Okay. Now let's go to the non-current asset, or we can also call it as long-term assets. In long-term assets, you can account building, machineries, equipments, and all that. But remember, any asset which is put to use has got wear and tear value, all right? So whenever you take an asset, for example, you have taken a machinery for $100, all right? Over the period of 2 years, the value of the machinery will go down because you are using the machinery for your production purposes, right? So when you go back to sell the machine, you will not get $100 value, which you have previously purchased for. You will get a lesser value of that machinery. Why you're getting a lesser value? Because you have already used and put to use the machinery. It has gone through the wear and tear process, right? Even though machine is in very good condition, it is immaculate, but still you won't get the price that you have paid when you bought the machine. So when there is a wear and tear value of the asset, which is reducing the value of the asset, then that is considered as depreciation. So when we look at the value of the equipment over a period of, let's say, after 2 years, we reduce the depreciation amount and consider that as the net book value. For instance, here in this sample balance sheet, you can see equipment is 9,000. Accumulated depreciation. Accumulated means over the years, like 1, 2, 3, 4, 5. Over the years, the depreciation has been accounted for 3,600. Now the equipment value in the books is 5,400. All right. Now there are several assumptions to it. This is the book value of the asset depending on the depreciation percentage applied. Some people apply 10%, some people apply 15%, depending upon the jurisdiction they are working, depending upon the tax laws of the country, depending on a number of factors. All right. This may vary, but if you go with this equipment in the market and try and sell for $5,000, $5,400 net book value, maybe you might get more, you might get less. It depends, but this is the book value of the asset, which is recorded on the asset side. All right. So if you see the total of the assets, current asset is 95,600, and long-term assets are, or non-current assets are 5,400. Total assets stands at 101,000. Clear? If you are from the Indian side, it's like 1,01,000 in total, and 95,600 total current assets, total non-current assets 5,400, and total assets as 1,01,000. Let's get onto the credit side, which is the liability. So what is liability? As I explained earlier, liabilities are all the payables from a company to a third party or employees. All right. So in similar to the asset, in liabilities, we will also have current liabilities and non-current liabilities or long-term liabilities. Okay. The current liabilities are liabilities which are basically for short term, and it will not stay in your books for a longer period of time. For example, you have to pay $100 to a supplier. All right. The supplier will give you 30, 45, 60 days, similar to the case of customers credit facility, and you need to ensure that you make the payment within that period so that gets out of your books. All right. Similarly, notes payable. If you have any notes payable, like for example, maybe there's some sort of cash brought in by the partner of the company, etc. All right, that you need to pay back to the owner of the cash who has got into the business. Accounts payable are payables which are to the suppliers, to third parties for the purchases done by the company. Purchases could be expense purchases, like you bought fuel for your business, you bought raw materials for the business, or it could be assets which you have purchased, or it could be an inventory. All together is considered as accounts payable. Salaries payable, if you have payable to employees end of the month, that will be considered as a liability. If you have income tax payable or accrued income tax payable, which the tax is payable but there is no due date to pay the tax, so you park it in liabilities. Unearned service revenue, this is bit technical. Suppose, for example, you are into a construction company wherein you are required to supply a building. All right. So the customer paid all the amount needed to construct the building. Let's say the building costed $10,000, and the customer has paid all the $10,000. But you have completed only half of your building. Okay. and the half is still under progress, still under construction. Okay, in your books as a business, you cannot record all that 10,000 as your sale. Okay, you need to record the percentage completion as sales and the balance in your liability. For example, if the building costed $10,000 and you have completed 50% of that construction, then in that scenario, you have to only record 5,000 as a sale and 5,000 as unearned service because you have not earned the service yet. When you complete the building 100%, then this 5,000 will go into your sales. Until then, your sales will be considered as 5,000 and the 5,000 will be parked in the balance sheet as liability. Why liability, you may ask, right? Why this is a liability when you have a customer who has paid you the amount? This is a liability because due to unforeseen scenarios, if you're not able to complete the next 50%, then you need to pay back this amount to the customer saying 50% is completed, 50% is not completed, 5,000 is our sale, and 5,000 have to be returned to the customer, including if there's a breach or something, you need to pay the fines and penalties. Okay, that is the reason why we consider all the advances received from customers as a liability, because you never know, we have to pay it back, or if we are not able to fulfill the contract, we need to return it to the customer, correct? So the total of liabilities, which is short-term liabilities, is 16,000 here. So let's go into the long-term liabilities. Long-term liabilities include capital. Capital is something which the owner has got the cash into the business, which is 50,000, and retained earnings. What are retained earnings? Retained earnings are the accumulated earnings coming from previous years. So if the employer is not eating up the profit, that profit will remain in the business as capital. Okay, so that will be clubbed with the capital, and the total capital which owner has brought in the beginning to the business is 50,000, and the profit which is earned by the business over these years is 35,000. So total of capital is 85,000, because this profit is entitled to be given to owner. If he is not taking this profit into his pocket, then this will remain in the business as his capital. We call the total retained earnings and capital brought as equity, and that equity is 85,000. So 16,000 plus 85,000 is 101,000, or if I say in Indian way, it is 1,01,000. Now, folks, you might have observed that the total of asset and the total of liability is matching. If this is the case, then the reliability of balance sheet is 100%. If any of the side, which is the left side asset or the right side liability, does not match, then there is a problem with the accounting entries, and this is not considered as accurate balance sheet.